Hello, everyone, and Happy New Year. This is Barry Mendelson, Wealth Advisor, Certified Financial Planner, and Managing Partner here at ZRC Wealth Management. I'm going to take you very quickly through 7 slides that we believe really define the fourth quarter and 2019 as a whole. Just to give you a brief update, 2019 was a fabulous year for the firm and for our clients, certainly buoyed by a fabulous stock market. As a firm, we added 9 new families and investors to our family of clients, to the more than 150 investors, families, and companies that we serve. Really delighted to have the opportunity to serve them in this very challenging, confusing market environment that we've experienced here the last several years. Today we manage more than 200 million in client assets for folks that are not only here in Northern California, but in a half dozen states across the country and 4 countries over the globe as well. Basically, if you are a U.S. citizen and have an internet connection, we can work with you. So thank you for that opportunity. As we look at the fourth quarter, it was really pretty amazing. The returns here that we're looking at across the top really were at or exceeded expectations, anyone's expectations of what we thought would happen in 2019. And this is just for the fourth quarter alone. Here you've got US stocks, and we're using the Russell 3000 as an index or as a proxy here. The 3,000 largest publicly traded companies up 9.1%. International developed stocks up 7.86%. And emerging markets had a great fourth quarter, up 11.84%. Global real estate ended up 0.8%, and bonds were mixed in the fourth quarter. Looking at the full year, returns were handily in the double-digit range. U.S. stocks up 31%. The S&P 500 was up 31.5%. International developed 22%. And then here you've got emerging markets up 18%. We saw a lot of volatility in 2019. If you think about it, 2/3 of emerging markets returns came in the fourth quarter alone. More than 12% of the 18% came in the fourth quarter. And I think that is a good example of why it's so critical to have an investment plan, to have an investment strategy, and just stick with it. Because if you are out of the market for a quarter, you would have missed out on 2/3 of the returns. And in fact, a lot of the returns here came in really just a handful of months, beginning of the year in January and February, where the market took off, and towards the end of the year as well. Pretty neat. Global real estate, again, despite a lot of people's expectations, believing that the real estate market is starting to get overheated, and yet global real estate as a whole did fabulous, up 23%. If we look at bonds across the globe, the US bond market and foreign bonds as well did fabulous, exceeded expectations. A lot of this was driven by governments and monetary policy, our Fed included, led by Fed Chair Jerome Powell, leading the charge to cut interest rates 3 times last year. Everyone knows that when you cut interest rates, what that does is increases the price or value of a bond, because it was presumably traded at a price that offered a higher yield before the interest rate cuts. So certainly cutting interest rates has the effect of rising bond prices, which is a win at bond investors back. So an unusually good year, given the modest yields one is getting from bonds these days, and not something that we should expect going forward. Looking longer term, 5 and 10 years out, especially for US stocks, handily double digits, and really one of the best decades in US stock market history. Part of the reason is that if you think about the last decade, this is a period of time where US stocks came out of one of the most depressed 10-year periods in stock market history, which was the financial crisis, which bottomed in March 2009. And that was bookended in a decade, were one of the worst decades in US stock market history, right? You had the dot-com collapse, which began in 2000, and then culminated 10 years later, March 2009, with the financial crisis. So a lot of people remember that decade as a lost decade. Had you just invested in large US companies like the S&P 500, your returns over that 10-year period were flat. As we've reminded our clients, thankfully they did a heck of a lot better than that because they were diversified into small company US stocks, which returned roughly 20% during that decade. Not great, but certainly better than nothing. But more importantly, they had international stock investments, which returned anywhere between 50 to 80% during that decade, which equated to single digit returns. And so again, you employ a diversified strategy, a globally diversified one like we do here at ZRC, you basically immune yourself from periods, extreme periods like we saw with that last decade. That's why it's so critical to own a lot of different investments that you know are going to do well if just given enough time. As we look at the last decade, what do we think is in store for U.S. stocks over the next 10 years? Well, I'm almost certain, and I can't say guarantee because the lawyers don't allow us to do that, but the next decade is not going to look like this. It's statistically, it's practically impossible. What we've experienced in the past, and we'll share in a couple different slides going back, is that every time there has been this divergence between U.S. and international returns, there's a rubber band effect where they snap back. And we expect this trend to reverse itself over the next decade. And that's why it's so critical to continue to maintain having exposure and investments in international stocks. If we look at the headlines over the last year, there is a lot of noise, a lot of fear out there, and rightly so. We just think about things that have been in the press over the last week, really terrifying stuff. We talked about the Mideast crisis going on now between Iran, where they mistakenly shot down a Ukrainian airline, killing all 176 people on board. Also, we think about the fires that are going on in Australia that are currently burning out of control, and it scorched 10 times the area of what burned in all of California in 2018. Really scary time here. Also, Brexit's grinding along. So if we just kind of base ourselves, make decisions based on, what we see in the press, the noise that we hear out there, and our own fears and inhibitions, we probably wouldn't do anything. We probably wouldn't own stocks, and that's the risk. The risk that, we don't participate in a single year like 2019, where globally stocks are up, in the high teens to low 30s. That's why it's important to be a participant, whether to even be a reluctant one, but just to own stocks through thick and thin. That's how you make money, despite the headlines, despite the noise, despite the fear that's out there. This is a great chart that we've repeatedly show clients. We call it the dragon chart because it's got a tail over here, it's a hump, and then opens up with this head. And what we're seeing here, we're illustrating are a couple different things. The gray line shows the performance of the S&P 500 largest U.S. companies going back over the last 22 years, back to 97. And here from the financial crisis, you can see this is where the rally really started again against all odds. And since then, stock market has appreciated considerably. One of the best, if not the best, 10 plus year run in the U.S. stock market history, up 378%. And here at the end, we note it's forward-looking consensus price to earnings ratio, just to measure where the stock market is priced now based on where forecasters and analysts believe it's going to produce future earnings. 18.2, which is about 30% more than its historical average. Definitely overvalued, but we don't think necessarily in bubble territory yet, for reasons we'll explain on the next chart. As we look at international stocks, what we call this purple line right here, the MSCI All Country ex-US, done pretty well over the last 10 years, returned about 124%, but a fraction of what US stock investors experienced. So if we had to pick and choose, we can see price to earnings ratios comparatively. International stocks are trading at about 78 cents on the dollar, what US stocks are. They're trading about 5% higher than their historical average. But one thing that is a real telltale measure to us is the dividend yield. And certainly now as US stocks have gotten more expensive, the dividend yield on them, which is another measure of value, has declined below its 20-year average. But international stocks, if they've haven't enjoyed and haven't been buoyed by this generally global expansion, global recovery. As we know, it's been pretty weak in Europe in particular. Their stock prices haven't risen with the rest of the world, Europe in particular. But the companies that operate in those countries have continued to do pretty well. So their dividend yield compared, relative to the price, has actually gone up. So if we look just purely on a cash on cash return basis, foreign stocks are very, very compelling right now. They're yielding about 3.3%. As you look back over history, and this goes back to 97, we've got charts and data that go back even another 20 years beyond this. Whenever there has been a period like this where there has been a divergence between the performance of the international stocks and US stocks, every single time it snapped back. Every single time there has been a reversion in the mean. We don't know what the future is going to hold, but what history, if history is any lesson, it's any indication that this gap will narrow and could do so pretty dramatically. The question we get a lot is from our clients, are stocks overvalued? We think there's some pockets that are pretty pricey, and stocks certainly don't need to be in bubble territory for there to be a significant pullback or correction. Certainly we saw that in the fourth quarter of 2018. Stocks declined, really in the United States by more than 20% from the end of September to the end of December. And that was based on two things. It was based on geopolitical risk, our administration sparring with China over trade measures, and fear over inflation. Neither one of those ended up materializing, but even still the stock market was down 20% over a very short period of time. And US stock, you had the S&P 500 down in 2018 about 4.5%. Small company stocks, generally the higher risk yet higher return stocks, were down about 11% in 2018. International stocks were even down more than that. So here we are, and we can see as we chart this again using forward price to earnings measure, which we think is an okay kind of it's a noisy statistic. We prefer this CAPE ratio, which is the cyclically adjusted price to earnings ratio developed by Robert Shiller, Yale economist and a Nobel Prize winner. But if you look at this here, only trading about 10% more than its 25-year average. So certainly not in bubble territory by any measure, not exceeding what we call one standard deviation by any measure, or anything close to what we experienced in the dot-com bust back in 2000. So we don't think there's any systematic risk in the market right now of a financial collapse or a bubble, but there are pockets that we believe are overvalued. What this chart shows is sector by sector in the S&P 500, what it returned in 2019. So what I'm going to show you right here, and there's a lot of data you can go back and look at and play with, but overwhelmingly what drove returns for 2019 in the stock market S&P 500 was technology. You can see tech alone was up 50%. Financials did pretty well, up 32.5%. And then if you got communication services, this is the old telecom, 32.7%. Absent those three sectors, everybody else was below the average of 31.5%. So obviously, technology was a big driver of that. And the number one driver of technology in particular, and there were a lot of companies that did better than 50%, was Apple. Apple's now the most valuable, publicly traded stock, returned 88% in 2019. And in the S&P 500, it represents about 4.5% of the S&P 500. In the Russell 3000, represents about 3.5%. In our client accounts, again, our clients own thousands of securities, represents about 1% of client portfolios. So this is a little bit of an area of concern for us because we are seeing some weakness in the technology sector, and also the valuations of what tech companies are trading for is it's not nearing bubble territory, but because a lot of these companies are not the dot-com companies with no earnings whatsoever, as we experienced in the peak in 99 and 2000, but a lot of them have such ambitious growth projections built into their stock prices that since we're in the late stages of this market expansion, and the expansion could continue for a while, but at the growth rates that we're seeing the economy grow, there's no possible way that the realized earnings that materialize from these companies could ever justify the stock prices that they're trading at now. That is a very, very broad statement there. I'll give you some examples. One of which was there, and I've got a link to it at the bottom of the presentation, is there was a study recently done, I believe it was done by a couple different folks, one of which was a professor of the University of Kansas. And he said, if you look at the IPOs, the companies that have gone public in 2018 and 2019, about 75% of them are unprofitable. 75% of them are losing money. And the last time that many IPOs, that percent of the market or IPOs were money-losing enterprises was back in 1999. So it has reached pre-bubble levels again. That is definitely concerning. And if you look at those IPOs, actually 40% of them are healthcare companies, a lot of biotech companies, about 12 of them are technology. So it's by no means concentrated in technology, but you are having a lot of companies that aren't producing earnings right now that have gone public, in the last 15 plus months. Certainly we have some pretty notable companies that have gone public, like Uber and Lyft. Are those companies going to go bankrupt? Are they going to go out of business? No, I think they are companies that have transformative technology, huge market share, and they're just refining their business plans, and they're here to stay. So, certainly those are swaying the statistics, but you have companies that are really under pressure to generate earnings, generate profits, and probably are not going to be with us for that long. So what is an investor to do from here? So one of the things that we always advocate, and if you're a client of ours, you've seen this chart, we review it at almost all of our annual review meetings, and it's called our Skittles Chart, and it just reminds us of the randomness of returns from year to year. And there's, as we look at over the last 15 years, you've got the best performing investment on top, and you've got the lowest performing investment on the bottom for that year. And again, there was not a economist, forecaster, talking head, or prognosticator that we're aware of who said US stocks were going to be up 31% in 2019. And I think that's just a great example of when we have years like 2019, how we need to take a step back and just appreciate the markets for what they are. Is that from year to year, they are random. And that you're going to have years like 2019 that come out of very terrible years where, again, the stock market and really fixed income included was down universally in 2018. And in why it's so critical to have a sound, common sense investment strategy that you can stick with through thick and thin. One of the things that's on this chart is, you look at the last couple of columns, is it shows the annualized returns over the last 15 years. And now with large cap S&P 500 stocks being the best performing investment in 2019, now they've exceeded REITs and emerging market stocks, their average annual returns over the last 15 years. Again, what I've said before is, if you look at how US stocks have done, over the last 6 years in particular, they have been among the best performing investments across the globe. That is simply unsustainable. And if we think about what's going to happen over the next 5, 10, and 15 years, that trend, as in every time in history, will eventually reverse itself. So just to prepare that you need to continue to be globally diversified and have investments in a variety of different things that are going to do well if just given enough time. Again, our goal at ZRC is have as much money as you possibly can in stocks, because that is how you're going to make money over the long term, and that's how you're going to, what we say, eat well tomorrow. But so that you can sleep well tonight, you're going to have money in fixed income. That's the safe, stable way to preserve your capital, and is single-handedly the best hedge of any portfolio ever. People talk about hedge funds. Hedge funds of the last decade have been a terrible disappointment. I can send you all sorts of articles on it, why the hedge fund industry is dying, and we can talk about that. But fixed income, we were reminded, serves as the single greatest hedge. And what you should have in fixed income is in line with your comfort, your level of comfort, and also your liquidity needs over the next 3 years minimum. And again, that depends on a number of factors based on your personal situation. So I'll leave you with a couple things and remind you of some resources that you have available. We've got a lot of articles that we post and that we keep online on our website. Some of the organizations, investment firms whose research we admire and really thought leaders are posted on here: Dimensional, Fund Advisors, Research Affiliates, who provides and manages the Schwab Fundamental Indexes. That article on money losing companies here is listed on the Wall Street Journal, and our contact information if we can be a resource as well. Here's a disclosure from the lawyers. Just to remind you, I'm not providing individual investment advice, and past performance is no guarantee of future results, and all investing involves risks. Thanks to our colleagues and friends over Dimensional Fund Advisors and JP Morgan Asset Management for providing lots of this information. Of course, if we can be a resource to you, we're happy to chat anytime and very accessible. All right, thanks for your time today, and look forward to being in touch.